right, so I am going to share my screen. All right, there we go. So just to kind of go over what we're going to be looking at tonight, the first thing is, again, last week we talked about the filing status and this bottom part here with dependents, how that impacts the tax return and what, things to look forward. Now we're going to be looking at income, which is basically all the sources we generally see from our clients. So that's everything on the second page of the intake form. Um, and we're going to really kind of go over lightly some of the things we don't see a lot of and a little bit more time with the stuff that we generally see a lot of. And we're also going to be looking at adjustments to income, which are things like student loan interest, retirement account contributions, HSAs, etc. And just a reminder too, the basic test is up. You might want to take a look at the first six questions, which don't require a tax return as we go through all this stuff. It's really pretty safe, self-explanatory, a lot of them. For instance, in looking at last week's um, session on uh, filing status and dependents, looking at all that, we can obviously answer question one, and after tonight, you'll be able to answer question two. Um, and same thing with, oops, come on, there we go. If question four that to be able to answer. So you get where I'm going. This all builds up to basically by the end of next week's sessions being able to pretty much answer at least the first six questions on the basic exam. So what we're going to do tonight is go over two items, income and adjustments to income. So let's just take a quick look here and go to this. Okay, so again, what we'll be looking at is, how the income pertains to the VITA return, the different types of forms that are used, where it all flows back to on the 1040, as well as how the calculation for total income is done. And as we go through all this, there's going to be a fair amount of uh, tax forms that are shown, particularly on the income side. A lot of them have old forms, like a 2022 for the W-2 or a 2023 for the dividend form. So ignore that. Basically, these forms have not changed, even though the tax law has evolved over the past 2 or 3 years. So again, this is where income flows on page one of the 1040, both on the A and the B side, the reportable amount and the taxable amount. So income, is gross income is received, any income received in the form of money, goods, property, services that is not exempt from tax. It does include sources from outside the U.S., sale of your primary residence, even if all or part of that income can be excluded. We do get an off and on few people that are, selling their primary residence. May include parts of the Social Security benefits received, and certain scholarship income, which we see one or two of those a year. Um, Again, income that is taxable must be reported, and is subject to obviously tax. And income that is not taxable may still, in general, have to be reported, but then again, that is exempt from tax. 'Cause remember, we're reconciling what was sent to the IRS with what the taxpayer got. Earned income is any income received from work, such as wages or self-employment income. Unearned income is any income not earned from work, which would be things like interest, any income from investments, interest on savings, dividends, capital gains, or rental income. And unless there is an exception, all income is taxable. It certainly is reportable. Um, Now, this is a chart from the 4012, which shows like all the various examples of taxable income. We see a fair amount of these, not all at once, obviously. The big ones obviously are W-2 wages, um, cash income, canceled debt, Social Security, pensions are pretty much limited to those folks that have retired who work for the state of New Jersey. We do see a couple of real retirements, which we'll cover at another time. Self-employment income, et cetera, et cetera. Unemployment compensation. Those are the big ones that we see. But so you can see there are a lot of different sources of income. So again, the lion's share of what we see is on a W-2. Important that, the box B has the employer ID number. Generally, those will be linked in a database that will, once you type in that number, it will flow through as to who the employer is. All the major employers, the Amazons, the Walmarts, the state of New Jersey, all the employer name, address, and stuff will flow through. And you're just copying over whatever's on the W-2, but both wages and federal income tax. If box 3 and 5 are the same, that will all copy down. Sometimes it's different because of retirement contributions, and that's something that we're going to spend a lot of time on when we start doing some practice returns, because there, in many instances, particularly folks that work for the state of New Jersey, this box 1 number is going to be very different than 3 and 5, as well as down here on box 15 and across what the state wages are. Box 14 is generally the of New Jersey, um, state of New Jersey unemployment tax, as well as the family leave tax. 12, box 12's A, B, C, and D. Those are generally things like the retirement account, the amount that the employer paid for health insurance. If there's an HSA contribution from the employer, it'll appear there in box 12. But again, most of our stuff is just on a W-2. Again, wages, it's going to be employer compensation. Again, if there's tips, again, if they're unreported, that requires advanced certification. This will change, I guess, given the legislation about tips being tax-free. Allocated tips do get reported. Again, if they're working at a restaurant and they kind of pool tips, that usually gets assigned there in line 8. Scholarship or fellowship grants reported on a W-2. Again, occasionally we get graduate students who are enrolled at Princeton or TCNJ who are teaching, and they may be getting a W-2 for that. Um, Again, you're entering wages, tips, etc. Make sure the spouse's income. Key what you see. That last one's very important. Taxpayer's address must be matching what's on the W-2 that they got. So if they move during the year, there could be multiple different addresses. So the W-2 has to match what the address was on that W-2, not their current home address. Again, there's some other items that we don't see: household employee, tip income not reported, taxable dependent care benefits. Again, not something that our clients are in the position to be getting that kind of benefit from their employer. Medicaid waiver payments are something that we're seeing more and more of. The payer of these is generally um, an organization that receives um, funds from either the federal government or the state government, and folks are paid to basically take care of a loved one in their own home. Mom and dad get compensated for taking care of a dependent child who is somewhat handicapped. It's generally not a lot of money. The key thing on this is usually a lot of things are missing on the W-2. Um, like you're not subject to Social Security tax. It's also not subject to federal tax. However, it should be indicated that you would use the income to qualify for the earned income credit, which is key, particularly for folks that are, again, that's their only source of income. Generally may be big enough to trigger a decent amount of earned income credit. A couple other things: employer adoption benefits. We don't see any of that. Wages on 8919. I mean, can't remember what that is. Other than income, okay. Occasionally, some type of retirement income will be coded differently. For instance, a 1099-R with a box 3 could be a situation where someone is under 65 but had to take retirement early because of some sort of disability. In that case, that income will also be treated as available for the earned income credit, provided they meet the income requirements. Non-taxable combat pay, again, I don't really see that. Again, very few people get some interest, but this is what it looks like, a 1099 INT. Usually have the bank name here, their TIN, social for the client, their address, and usually the only thing we'll see the income amount in is in box 1. So that's, again, it goes straight to Schedule B. We have a little we'll go over all this. A special form for just to report interest income. All you have to do is write the bank's name in. You don't even have to put in the EIN. We'll get back to what in a little while what early withdrawal penalty can mean for folks. Very rarely will we see any kind of federal tax withheld. Again, you can also see the interest and dividends on a composite statement from a brokerage account. Again, don't see very many of these, and usually it's a very, very small amount of money if we do. Taxable interest, again, it's on a consolidated statement. It could be anything from interest on a checking account, CDs, savings certificates, U.S. government bonds. Again, if we will create a Schedule B no matter what. That's what the software does, the way that we input it. Frequently, some people will write down what their interest is, even though they never got a 1099, because if it's less than $10, the bank is not required to send the client a 1099. Again, if they write it down, we have to report it. Tax exempt, again, we generally don't see much of this, but if they do, again, tax exempt income could come from state political subdivisions, um, DC, port authorities, other types of political subdivisions. Again, that gets reported on line 2A. There are other boxes on the interest thing which we can put input for, again, the few occasions when that does come up, but primarily all we're ever going to have is just basic bank interest that would be on a 1099. Ordinary dividends and qualified dividends. So again, similar form to the 1099 interest. You have the bank over here, or the company over here, or if it's a brokerage account, we'll say Fidelity or whatever over here and their TIN. Total ordinary dividends, qualified dividends. For most of our folks, they'll be the same. Again, there may be federal income tax withheld. I only say to kind of focus on that because there is a question on the basic test that actually has a 1099 that they did take tax out. Again, I never see it. I mean, I get 1099 dividends. We never have tax withheld. Again, dividends are corporate earnings paid out or profits from the corporation. They're reported online. They flow through to the 1040 line 3B. Generally, they come from a brokerage statement as well. Again, they're usually dividends from the share of domestic corporation. Um, Qualified means they're held for a certain period of time. Generally, you're going to get the capital gains rate, which is lower than your income tax rate. And for most of our folks, again, it may be part of a mutual fund that they have, which is generally held for at least a year. So that's why you're going to get the qualified dividends are the same as ordinary dividends. Capital gains distribution is when, again, something was sold at a gain or loss, mutual fund, real estate investment trust, or just actual common stock that is held by the client in their account. And rather going straight into the Schedule D or Form 4999, 4949, we have a little shortcut in TaxWise. It makes it very easy to input the data so it goes to the right part of Schedule D. So those that are short-term gains or losses or long-term gains or losses get allocated appropriately, and the tax rate is calculated correctly. IRAs, pensions, and annuities. The reality is that, again, all three of those use basically the same type of form, the 1099-R. As far as pensions go, the only real pensions we're going to see are from the state of New Jersey, which will be, say it right there, or possibly some folks who were tradespeople and they were in a union. So the Carpenters Union has a small pension plan, and the gross distribution and the taxable amount in our world is almost always there. And generally, it's very close between what the taxable amount is and the gross amount. If they have an IRA, which again, most of our folks don't, it's going to come out, it generally gross and the tax will be the same. There should be some federal tax withheld, hopefully. And then the distribution codes, and we'll get into that a little bit later about how that drives a lot of stuff. IRA income, retirement income is taxable in the state of New Jersey, so there should be some state tax withheld. But the reality is, given to the pension exclusion in New Jersey, most people in our income cohort and are 65 and older will owe no state tax on their pension income. That's just, 5 years ago when they increased the gas tax and they went through this whole thing with excluding uh, pension income for seniors. That was meant to kind of like offset some of that. So very rarely will we see anybody in our cohort over 65 that owes any state tax to New Jersey. For those that we see from Pennsylvania, Pennsylvania doesn't tax that anyway, so no issues there. Again, some more stuff here. Again, the total amount the client received in box one. Again, that will flow to for line 4A. The taxable amount should be calculated. Um, again, if there's not anything that's there or taxable amount not determined, that needs to be an advanced certification. Generally, the sites coordinator or myself can get involved. There's only a few places where that really comes up regularly. One is if someone receives a pension from the Office of Personnel Management, so they were a civilian employee of the federal government, there's chances are that that will be blank. And depending on how long they've been retired, basically the reason is that you should have to calculate that taxable amount. But if they've been retired for a fair amount of time, the amount that they contributed has already been um, uh, retained as far as non-taxable. So chances are, in 95% of the time, the taxable amount will be the same as the uh, uh, original amount, the gross amount. Others might be what the Railroad Retirement Board wants, and we'll go over that when we look at advanced topics sometime in December. Okay, key item in retirement is what drives box seven. The ones that we see primarily are a seven, which is a regular distribution, someone's 59 and a half or older, it's just taxed as ordinary income. If it's a three or a four, that's death or disability. Again, generally the same thing. If it's disability, okay, and they're under 65, that's gonna allow them to potentially, that will be treated as ordinary wages for purpose of determining whether or not they can qualify for the earned income credit. The other one that we see fairly regularly is a number one, which is a um, early distribution. So someone under 59 and a half took the money out, and now they're subject to the additional 10% penalty in addition to whatever tax rate they might get hit with. A lot of people don't know that when they take it out. A lot of the ones that we see are generally small amounts. I use the example of when my son got one of his first jobs out of college. It turned out it was a pretty crappy job, but the company did start throwing in some money into an IRA. And when he left, he cashed it out. And so it's like literally $1,000. So that wound up costing him like $100 in tax, which is a good lesson learning in talking to people about how this works. The sad part is when some people take out a big distribution to just meet ordinary expenses or to buy a car. So there's no way to get around that you can't avoid the penalty with that. I mean, first-time home buyers, education expenses, you can get some relief from that. But again, we generally don't see that. And the reality is most of our folks don't have IRAs or any kind of annuity income, which means they've saved accordingly. Um, so again, ones, three, four, and seven are generally the codes that we see. Social Security benefits, you're going to see a lot of these. Um, and this is what a standard Social Security statement looks like, even though it says it's from 2020. Box five, which is colored in like a pink color, that's the number that we record. That is their benefit amount. Again, there may be some paid back to Social Security for people who make too much money. Social Security kind of keeps some of that. And then benefits paid. And there's a breakdown of other items that are taken out of their Social Security, primarily their Medicare B premium and they're generally their Medicare D premium if they're going that direction. That is, you enter that into our worksheet as well. That will accumulate as medical expenses should they, which will qualify for if they're going to itemize, which again, almost nobody does, but it's there just in case. If there's tax withheld, that goes here. Again, that gets recorded on the same worksheet. And again, a lot of our seniors um, have tax taken out for the only real reason is because that way they know they're going to get a refund. even though they know that after all these years, their income is at such a level that they're subject to no federal tax. They have money taken out, so they get a $1,000 refund, every March or April. You're going to see a lot of that. Again, we report the number that's in pink. Again, the Medicare premiums. Again, the bottom part there, again, the taxable portion of Social Security benefits is never more than 85% of what the taxpayers receive. That actual calculation is rather complex, but the software will do all the work. You don't have to really figure that out. Um, Again, it's a combination of other income, of non-taxable income like uh, uh, interest, etc., tax-free interest, other things, whether or not they're filing jointly or single. And if there's a lump sum payment, there's some work we would have to do there, but I haven't seen one of these in 2 or 3 years. A lot of people sometimes when they apply for whatever reason, it takes a while for this to get processed, and they wind up getting a big lump for multiple years. And there are ways to mitigate the tax hit on that, but we won't. We're not going to go into details on that. That's something that we have to figure out once, if and ever we have one. Capital gains or loss. Again, this is an advanced certification level. Um, Again, you might get that from the sale of your primary home, from mutual funds, stocks, bonds. Again, usually a sale of the home is not going to be a problem because most people will get the exemption of 250,000 if they're single, 500,000 if they're married. Again, all that will flow through Form 8949 and Schedule D. If there's a loss carry forward, in other words, they sold stock at a loss, and they can't take advantage of that loss, that will be maintained by the software as long as they come back to the same site the next year. And we do see some of that occasionally. We do have some folks that have some financial assets, and we do have to deal with capital gains and losses. It's not a lot, that's for sure. Um, Occasionally, the last one, we will see some Bitcoin trades. That was kind of popular during the pandemic. That's kind of disappeared a while. We had a fair amount of people who, dabbled in a Robinhood account during COVID with those fractional shares, and it was really tiny amounts of money, which is very difficult to track. In many instances, it didn't even add up to dollars, so we didn't even bother with it. Okay, again, long-term gains are generally held for more than a year. Again, if it's short term, it's less. Again, as long as you have the proper dates, the software will do all of the calculations for you. Cost basis, there should be cost basis for what they paid for the stock that they sold should be on the brokerage firm's 1099-B. If not, we have to do some sort of due diligence. It's very rare that we're going to see people that don't have uh, cost basis on their 1099s. Okay. All right. So now we get into some additional types of income that we see. Again, a lot of that we just have people are going to get forms from their employer, Social Security, retirement income, banks, brokerage, etc. Now it's something a little different. So additional income, there's a lot of different sources of it, and eventually it will all flow to Schedule 1, and then Schedule 1 will forward it to the first page of the 1040. These could be things, taxable refunds, of state and local income taxes, alimony, business income, other gains and losses, rental real estate, which we don't do, but there could be royalties that come through on a 1099, gambling, we do see gambling, cancellation of debt, jury duty pay, unemployment, that's something we see. Again, some of these can get out of scope, particularly rental real estate we don't do, any partnerships or S corps we don't do. Again, that's where everything gets aggregated on line 8, Schedule 1. And that's what Schedule 1 looks like. Actually, I think this is a 2023. I think there are more items now. So there's some that, again, you're not going to have all of this on any one particular tax return, but there could be a whole bunch of different stuff. So taxable refunds, when a taxpayer receives a state income tax refund and took the state income tax as an itemized deduction in the prior year, we need to copy that return to make sure to see how much of it is taxable. The reality is that, again, if you don't itemize, you don't have to report state and local income taxes refunds. So we generally don't have to worry about that. And that would come with a 1099-G. Most people do get that if they have they get a refund. But again, we were talking about a world where the vast majority of our clients are renters. So there's almost no chance that they're going to itemize. So there's no need to really focus on that. Alimony received, okay, again, after 2018, if the divorce is after 2018, there's nothing we can do both on the amount received and the amount paid. Prior to that, again, that goes on on Schedule 1, and you need the payer's name and social security number for that amount. Okay, business income, we'll spend a bit more in a bit more detail when we get to advanced topics and looking at how to do a Schedule C. Again, these are folks that are become self-employed, and there's several categories that it really fits into. Generally, it's people who are doing some sort of cash business. In our world, it's generally house cleaning, maybe some landscapers that are paid in cash. Or they could be, if they're a little more dialed into the system, we're talking Uber, Lyft, DoorDash, Instacart, that kind of stuff. Delivery, uh, package delivery for like Amazon, Walmart. Again, they're going to get a report of their income a couple of different ways. 1099 NEC or non-employee compensation, the 1099K, which is the merchant's card, and third party payments. That's uh, Uber and Lyft, basically. There could be W-2 statement that they're a statutory employee. I've never seen any of that. Their own taxpayer, their books and records, which includes cash. A lot of people that say I made, $10,000 in cash. And how do they get to a nice round number with that? And that's important that we communicate that they have some way of, again, the letter for proof of that is not coming to us, it's coming to the client. Where's your books and records, not only for the amount received, but the amount that you paid out in expenses, whether you were driving your own car, you bought supplies for your cleaning business, et cetera, et cetera. Um, real estate, royalties, partnerships, etc. Generally, all these things are out of scope. Royalty income could come through a brokerage statement. In other words, if they have some sort of investment in like some sort of oil well, oil producing natural gas well or something, that would generate a Schedule E, which we can file, but we're not really creating a Schedule E. That would be if you use it for a rental property. Again, if people do get income from an entity that generates a K-1, a partnership, a state, trust, we can go ahead and do that. Again, someone, a deceased uncle, you're on there as a beneficiary, and the estate is paying out X amount of dollars, and you get the K-1 to show that we can take care of. Generally, it's usually for minor amounts of money. They're generally not commercial K-1s, like from oil and gas partnerships, which are very popular. Okay, unemployment compensation. Again, we see a fair amount of these in the state of New Jersey. You don't get any. They do not mail out the 1099s anymore. Some of our folks who aren't tech savvy, they can go down to um, the Office of Labor in Trenton, and they'll print one off for you. Or for most folks, they just can get the 1099 on their phone, which is fine for us. We don't need to see a paper copy. In fact, we encourage them when they're doing their intake to pull all this kind of stuff in, write it down, which is good for us. Again, how much they got in box one and how much did federal taxes withheld. Ideally, they should take 10% out. The state is generally pretty good with that. Um, and we do have this hard coded in tax wise, so you don't have to worry about what the TIN is for the Jersey Department of Labor. Okay, some other income. Again, there's some other things here, scholarship and grants, gambling, cancellation of debt. So gambling income, again, we see a fair amount of those. Includes things from lotteries and raffles. Winnings are reported via the W-2G. That will come from the casino. A lot of people, it indicates on there that it was all lost. That gets a little complicated when you're itemizing. Again, most of our people who win, I'll say win big, they lose big too. So depending on how much they win, and if they lost all of that, maybe they can itemize, if only to offset the income. Now, the one thing that has changed this year, if you win $10,000 and you say you lost 10,000, I mean, you won 10,000 and you lost the same 10,000, only 80% of the losses this year are going to count. So you're going to wind up on the hook for at least $2,000 of income that will be taxed. Now that's part of the big beautiful bill, which is still being worked on with the software as well as some of the paperwork that we use for VITA. None of that is on the test, by the way. It's just all pretend like none of that stuff happened. We'll only deal with that when we get once we get into the new year. Cancellation of debt, we do see a fair amount of that. That only it only we can deal with non-business credit card debt, which again we see fairly often. The rationale behind that is, people, if you owe, $2,000 to Chase, and Chase forgives the credit card balance, you're going to get the 1099-C, which shows the canceled debt of 2,000, and that is considered income. Now, some people say, well, I never got the income. Well, the way to work around that is, well, you don't owe Chase $2,000, but you do owe the tax on 2,000. So at 10%, owing 200 is a lot better than owing 2,000. And usually that kind of gets people on the, thinking the right way. Also, it's not, credit card debt is not subject to tax in the state of New Jersey. Again, jury duty pay, if they said they got it, they weren't reimbursed by the employer, it's taxable. Um, Place elsewhere. Again, there are other miscellaneous items that come up. When somebody gets a 1099 miscellaneous, you need to kind of look at that and you got to say like, well, what does this mean? What other income? What did you do to get this? I use the example every year in my paid practice. I have a guy who parks cars or helps with the parking during graduation over at Ryder. And he gets like $150 for that effort. And they send him a 1099 miscellaneous. So it's not like he's in the business of parking cars. It's just income that he obviously has to report because Ryder reported it. Same thing, like I had another client uh, who a who played the organ during the Christmas holidays at her church because she's an amazing organ player or whatever. I don't know. And they gave her a stipend of X amount of dollars. Gave her 1099 miscellaneous. And she's not in the business of soliciting business as far as like playing the organ, but there you go. You got to report that stuff. Again, these are the basic kind of brackets that, again, for basic certification, other types of income, where it flows. Again, alimony, unemployment, taxable refunds if it were to be reportable. That's all for basic. Advanced is for business income. And then these other things that are out of scope, rental real estate, farm income, etc. So a little more about other income and how to relate to some of these forms. Again, what is other income? It's something that doesn't easily fit into the other categories. It's cash earned from side jobs, barter exchanges, awards, prizes, gambling proceeds. Again, there was this big push, both it seems to be coming and going with people who and this gets goes on like barter or the sale of goods or services, selling things on eBay or any other or Facebook Marketplace, and they're making money on this. Well, again, are you selling a couch that you had in college that you spent $1,000 for, and now you sold it for 50 bucks on Facebook Marketplace? Is that reportable? Well, if you get a 1099 miscellaneous, chances are it's reportable. But again, you get to kind of make that go away, and we'll get into that down the road. We're not really seeing a whole lot of that. This was really geared for people who are sort of making a killing in certain areas of the sort of the over the counter market. I would say things like, selling Taylor Swift tickets for, $2,000 more than what you paid for them. That is definitely, something that they want to latch on to. Same thing with any kind of sports events, people that send their giant season tickets and they make money on them, or probably not this year. If they make a loss, you can't take the loss either, but the gain is reportable. Again, the miscellaneous will come Yeah, in one of these, it's generally going to be other income. And again, then it's like, what is this other income? How did you get this? We had a gentleman come in last year, unfortunately, who, again, limited English. He had like, I think 5 or 6 of these 1099s, and literally he was following a rodeo circuit up and down the East Coast, basically shoveling, sawdust and horse manure. And he made like $40,000, but it was all on 1099 miscellaneous, no tax withheld. So needless to say, he had a pretty nasty tax bill. The question then is he being miscategorized as a contract employee? I would say yes, but that's not really our place to get involved. It's certainly to educate them that you're going to have this problem year after year after year unless either you pay quarterly taxes, which most people in this situation are not in that situation to have that kind of liquidity to try and be ahead of the curve with their tax obligations. Royalty income, yeah, that's all advanced certifications. Yeah, that's that. Um, Again, if they have withholding, that's great. Generally, they don't. So the impact on the return. Again, business income. When they have business income, again, they're gonna need to require a level Schedule C. So if they're driving Uber, they're gonna be a Schedule C. A lot of the people that we aggregate them for, because very rarely are they just doing for one vendor. They're driving for Uber, they're doing Instacart, they're delivering for Walmart. So we aggregate all those 1099s and try and aggregate all of their expenses as well. Again, if the net income generates is more than $400, they must pay self-employment tax. And we'll get into that as well, and how the adjustments for that work. Um, Again, all of the other income again is going to flow through. And again, it's not going to be subject to self-employment tax, but it will be subject to, no, excuse me, ordinary income tax. Again, other income is generally reported on the 1099 miscellaneous. Um, and again, other stuff, all that stuff generally is basic. Scholarship income, which we see more than you would think. We'll get that over next week in Module 8. Generally, that's for folks that have above and beyond the scholarship that's paying for their tuition and expenses. So particularly room and board. Some people can get hit with a pretty big tax bill depending on, again, how generous the school is. So now we're going to talk about adjustments. So how do we get the income number down? That's the whole point. We want to get that taxable number as low as we can using the available adjustments to income. So again, adjusted gross income affects any tax liability on the 1040. So these are the main ones that we'll be dealing with: the educator expense, penalty for early withdrawal, alimony paid deduction, student loan interest deduction, employee health insurance deduction, the HSA, and the IRA. We don't see a lot of any of these, but we do see enough of them throughout the year. So again, total income minus the adjustments gets you to adjusted gross income. So remember, we're not getting, they don't lower the taxes necessarily like self-employment tax, but they help lower the number to the point where, again, that's when the tax gets calculated after the standard or itemized deduction, which we'll discuss next week. So here's an example. Taxpayer has $20,000 in gross income. He has these expense deductions: $300 in education expenses, $50 for the penalty for early withdrawal, $2,000 alimony paid, and $1,000 in student loan interest. What's his AGI? Well, you add up all the red and you subtract it from the green of 20,000, and his AGI is 16,650. Again, now that's before the standard deduction, okay? But this is 3,350 that he doesn't have to pay tax on. So the educator expense deduction, we see a few of these. You can do $300 for a single, 600 if they're married filing jointly and they're both educators. Again, you have to be in K through 12, either a teacher, instructor, counselor, principal, or aide, and at least 900 hours during the school year. And these are the expenses that teachers and aides, whatever, pay during the school year, all kinds of stuff, which again, everybody who I've talked to gets this deduction spends a lot more on that than this. So, crayons, books, paper, etc. Even supplies during COVID back in the day. Again, homeschooling expenses, non-athletic supplies for courses in health and physical not included. The penalty for early withdrawal, if you have a CD and you take it out early, you're going to get hit with something in box two. That can be used as an adjustment as well. Again, not a lot of our people have time deposits, so we're not going to see that very often. Again, I'll leave that go there. Okay, alimony paid. Alimony paid to a divorced spouse may be deductible as adjustment to income that reduces AGI and the recipient spouse's income. Okay, this is basically anything after 1985 and before 2018. All right, again, alimony paid again is deductible as an expense. You got to include the where it went, his or her social and their name. Again, there are things that may negate that. So in other words, the ex-spouses did not file jointly. The other one hasn't, none of them has gotten remarried. Again, none of this includes things like child support, any kind of property settlement. This is strictly court-imposed alimony. Again, that flows through the reporter's Schedule 1. Um, Again, an example here, the taxpayer made alimony payments totaling $2,500 in the past year. They also made child support payments totaling 1,000. How much can they deduct for the alimony pay deduction? Obviously, only $2,500 because child support never counts as anything for anybody. It is just an expense of living. Okay, IRA calculations, only contributions to traditional IRAs are deductible. Okay, for 2025, the maximum is 7,000 for either IRA or Roth, but again, only the IRA accounts, and you get $1,000 more if you're 50 and older. Uh, the reality here is, I think in 10 years, I've seen maybe one or two folks that make a non-payroll deduction IRA contributions. They actually sat down and wrote the check to Vanguard or Fidelity and sent it in. Again, this is not to harp on it, but we deal with folks that do not have this kind of liquidity to set something aside for an IRA unless it's taken out of their paycheck, which again, that gets dealt with another separate, you don't have to do anything because it's reducing their box one income. Student loan interest deductions. Okay, we do a fair number of people who actually, went to college and are paying student loans off. Up to $2,500 of the year can be taxpayer paid interest. They must be legally liable for the loan. You can't file married separate. That negates this deduction. They can't be declaimed as a dependent on someone else's return. Um, they must have a form, the 1098 from the bank or Sally Mae or whoever who issued who's managing the account. Okay, there's additional adjustments. Okay, the only two that are really something that we see are the HSA deductions, which we'll get to shortly, and the self-employment tax. Other things like certain business expenses for reservists, moving expenses of the armed forces, um, self-employed folks, SEP and Simple, and self-employed health insurance. Again, we don't see any of that, plus it's out of scope. So health savings accounts, the only ones that, again, if most people do not pay into their own HSA, it's generally the employer, in order to meet the requirements of the health plan that he has for his employees, must have an HSA set up, and frequently they throw in, I believe, up to $600 as they'll call it wellness or whatever, because it's a tax advantage for the employer, and most people don't even know that they have it. That will be covered with a box W uh, for a box 12 code for W, and that will have what the employer put in. Very few people will ever put anything above that. Here's the rules, that determine when you can have an HSA, high deductible health plan. You can't be covered by another insurance, can't be in Medicare, and can't be claimed by somebody else. Down here, these are the limits for contributions above and beyond what the employer puts in. Again, I'm not even really go into it too much. The important thing is that they understand that they do have it. A lot of them, it's a surprise to them when you tell them. Some of them do use it. They get the card, and they'll have the printout from the manager of the HSA, who will show them on Form 8889 what they spent it on. And we usually have discussions like, okay, you took out the $500 for prescriptions or even over-the-counter stuff. As long as they say yes, that's fine. It's very rare that, a situation would come up where they said, I used I used my HSA to buy groceries at Walgreens. That would be subject to a 20% tax then. Self-employment tax, again, anybody who has above $400 in net earnings on their Schedule C is going to be paying self-employment tax, the full amount, both the the employer side as well as the taxpayer side, but then you get to take half of that as an adjustment on um, uh, reported income. And again, we see a fair amount of folks that do Schedule Cs, and that's all done automatically. Okay, so here's something which, again, this is a number of bullet points that we generally would not see all at once. Pat and Chris are married. They wish to file a joint return. They are each 27 years old, no children. Pat teaches third grade, spent 1,400 hours in the classroom. Chris is social services case manager. Their combined income was $60,000. They had $2,000 in investment income from a CD, which they cashed in 6 months early to pay for a new air conditioner. Okay, so here's some of the particulars from all of that. $600 in classroom expenses, $2,300 in student loan interest for Pat, $1,700 for Chris. Again, they're covered by a high deductible health plan. Chris's W-2 shows $1,200 in box 12 with a code W. Pat contributed to $1,000 of a Roth IRA, and there's a $2,200 early withdrawal penalty for cashing in that CD. So again, this is the expenses they hope to deduct. Yeah, so which ones can they deduct? What would be the total amount that they can adjust for just take an adjustment? So what we go to look for here is 3,000. So here's what they can claim. Again, Pat was the only one that was an educator, so you can take $300 of that. Um, they can also claim $2,500. Remember, it's the interest combined, so on the return, not per person. And they can claim the $200 early withdrawal penalty for the CD. So the stuff that's left on the table, so to speak, the excess classroom expenses and the extra student loan interest, can't do anything with that. The code W represents the employer contribution, so they can't do anything with the 1,200. And again, only traditional IRAs are allowed. So the $12,000 Roth contribution just goes away. All right, so that is it for the adjustments. So remember, those again, once all those get added up, that gets us down to where we're going to adjusted gross income, hence the adjusted gross. So I'm going that kind of wraps up that one. I'm going to go ahead and stop the share and stop.